Is it wise to blindly follow somebody else's trades? Is it wise to jump into a trade when the asset is overvalued? Do you constantly experience regret in your trades? You start to worry that if you don't jump on this opportunity right now, you'll miss out on huge potential gains and be left behind. This is the fear of missing out in action, and it's something that many traders struggle with daily. While fear of missing out can lead to impulse trades, it is essential to approach investments with a level head. In this episode, we'll explore the various ways to avoid falling into the FOMO trap and highlight some real-life examples of traders who have missed out on trading opportunities. How to overcome FOMO while maintaining focus on your trading strategy. Number 1. Understand that missing out on trades are common. Missing out on an opportunity can happen to anyone, even to the most successful investors like Peter Lynch and Warren Buffett. Lynch, the founder of the successful Fidelity Magellan Fund, recently revealed his regrets in an interview for not believing in Apple. Even with a solid balance sheet, Lynch did not conduct a thorough research on Apple, which ultimately led to a missed opportunity to invest in a company that has since become one of the most valued corporations in the world. Similarly, Buffett admitted in an interview in 2019 that he too has missed out on an opportunity to invest in Google due to his lack of understanding of the technology industry. Despite missing out on Google, Buffett was not particularly disappointed, as he had famously avoided opportunities in the technology industry in the past, including Amazon. These examples demonstrate that missing out on an opportunity or two is a natural part of the investing process, and that even the most successful investors can make mistakes. It is important to conduct thorough research and properly understand the market and industry before making investment decisions to avoid the emotional roller coaster of FOMO. Number 2. Be discerning and exercise foresight. When trading, it is important to be very selective about the information you consume and the trades you take to avoid unnecessary risks. Focus on high probability opportunities, that is to only take trades that have a favorable risk-reward ratio, as well as setting appropriate stop losses. Have a clear set of back-tested criteria for identifying trades, which may include technical analysis, fundamental analysis, sentiment analysis, or a combination of all three. By using a systematic approach to evaluating trades, you can easily avoid impulsive decisions that are based on FOMO or other emotions. Number 3. Understand your trading strategy inside out. It is important to understand your strategy inside out, so that you would not be easily swayed by emotions. Backtest your strategies to know whether it's a trend or range-based strategy. Don't be a one-trick pony and be prepared for any market condition. There is an infamous strategy called the martingale strategy, which is all about doubling down when you lose, so that you can eventually recoup your losses to turn the tide and make a profit. It's the ultimate, never give up, I'm always right mentality. However, as we know, the market is always right, not you. Hence, this strategy can potentially be profitable during ranging markets, but can also be incredibly disastrous during trending markets. Knowing your strategy will naturally give you the confidence to set realistic goals, which includes profit-taking and cutting losses. Remember, trading is a long-term game, opportunities come and go. It's important to prioritize your goals and stick to your strategy. Being independent can help you avoid overtrading as well as make better decisions. So, stay focused, be selective, and don't let FOMO cloud your judgment and distort your perception of the risks involved. We hope that you've learned more about FOMO today. Be sure to like, share, and follow for more actionable investment insights now.